you're kind of tempted to buy gold, and it's getting all the news headlines, and the institutions are buying gold, and central banks are buying gold, and gold, gold, gold. But you look at that ratio, man, I'm going to buy silver because I want cheap gold. And you buy it 100 to 1, then it gets to 50 pretty quickly when it moves, and you swap that, you feel pretty happy.
Now, when you're talking the 70 to 80 range, you're talking about the gold-silver ratio here?
No, I'm talking about the silver price. It's recaptured its bullish trend, and I think we're going to go up again. But I also think we have consolidation to work off the large increase that we've seen. I'm pretty convinced we're going to see a sideways action in a trading range for both gold and silver for probably 6 weeks or thereabouts. Saw a trading range between 70 and 90, which is a big spread. It looks like it's going to be more like 70 to 80. If you get in the war cycle and you actually see the silver price go down for a while, and then you can see it bounce back. Overall trend is very clear. We're using up more than we're mining. We're using up more than we can recycle. It's going to be very tough to meet the demand without a big increase in price. In and out, in and out, in and out. But basically pretty darn flat as the amount of physical silver. And the reason for that is that a lot of the deliveries are bank to bank. So the silver actually sits in the warehouse, but the new owner is holding that in the same warehouse. So for example, you could see a pallet full of commercial bars, and it says JPM for JP Morgan. And then after the delivery month, JP Morgan is delivered to HSBC. So the tag that says JPM gets pulled off that pallet, and the sticker that says HSBC gets thrown on there. And that's almost literally what happens. Now, not in every case, of course. But what we're primarily interested in is how much silver comes off or out of the Comex warehouse. And so what we could see in 2025 is we have this huge influx of silver coming in to the Comex warehouses. We call them vaults. That's what they are. And we saw that rapid increase. Now, some say it was tariffs, some say it wasn't. I'll just say facts are facts. We got an increase in inventory, regardless of the reason why. And then it flattened out, and that same amount of inventory basically left the Comex warehouse for kind of an in, leveling, and an out. And basically back to the starting point where we started in 2025.
What looks like rising inventory is often just a paperwork shuffle, not real supply growth. As David Morgan points out here, most Comex silver never actually moves. It's relabeled between banks like JP Morgan and HSBC, masking true availability. That means the 2025 inventory surge may have been more optical than structural, raising questions about how much available silver is truly liquid. For investors, this matters because reported stockpiles can overstate supply, distorting price signals and risk models. Next, David Morgan discusses where that silver is actually going when it finally leaves the system.
So we're slightly below that. But what is important, and I think Andy Schechtman has made a point out of this, that in the last few months, we've seen a rapid outflow from the Comex warehouses to wherever it's flowing. I would suggest some to the LBMA, and I'd say most of it from, I think, everything that we that follow the silver market can determine on a best effort basis over into Asia, into the Shanghai Gold Exchange, Shanghai Metals Exchange, the Asian market, and India too as well. So those two markets. So the idea that you can just look at what the open interest is and how many people are standing for delivery, you got to take it with a bit of a grain of salt, because even though those deliveries are valid, many of those inventories and exchanges really don't move the overall supply in the company. That's my point.
Looking forward then, do you see any, stressors coming for Comex inventories of silver? I mean, there's, if you search on YouTube, right, a lot of people are thinking, we could see a Comex run out of silver eventually, but do you see that as a possibility or any signs of that we could be kind of heading towards a day of reckoning?
I think we are. I mean, if you go back and look at, some of my earlier work, I have made the proposition that at some point where there's a very strong demand that might not be met or delayed or that type of thing. And we have already seen that occur a few times. I mean, Andy Schechtman of Miles Franklin has talked about a point in the retail market where he could basically not find any silver for retail products, and that I turned him on to an outfit that was in the industrial side called Pyromet. And Pyromet was making 100-ounce bars that were not the best looking bars ever, but that was, I think, if I recall correctly, about all he could source for a while as far as silver product. Now, that subsided over time, but we've also seen on the commercial bar side. I remember, I think it was the second tranche that Sprott Asset Management bought for the PSLV. And if I recall correctly, it was 22 million ounces, I believe correctly. And the silver was delayed, not by a lot, by a few weeks, but nonetheless, the demand delivery date was not met.
The real story isn't Comex inventory levels, it's the silent drain toward Asia. As David Morgan points out here, silver is steadily flowing out to markets like Shanghai and India, where physical demand is stronger and less speculative. That shift challenges the reliability of Western indicators, like open interest, which many investors still treat as gospel. A 22 million ounce delayed delivery may seem minor, but it exposes friction in a system assumed to be liquid. For portfolios, this signals tightening physical supply beneath stable paper metrics. Next, David Morgan unravels whether these cracks could escalate into a broader supply shock.
A lot of it was, but there was still, I forget how much, 5% or so that had not met the delivery date. They came in, and so I got pretty excited. They're very short on commercial bars, which is really the silver market. I mean, retail is very important, but it's a derivatives market based on commercial bars. So that's what I focus on. I focus on everything, but that's the one that really see what would occur as far as a quick movement or a quick adjustment in price. Because if you couldn't deliver 1,000-ounce bar, that would really throw a wrench into the gears, so to speak. So I thought, that's it. Well, a year or two goes by and they have another tranche, which was, I think, greater than that one. And, they delivered it early. So, I mean, the silver market does ebb and flow. And there is always, more mining, more recycling. And sometimes the market is very tight and sometimes the market isn't so tight.
A 5% delivery delay sounds small until you realize the entire pricing system depends on it working flawlessly. As David Morgan points out here, the silver market is driven by large commercial bars, not retail coins, meaning even minor disruptions can ripple into price volatility. But the follow-up tranche being delivered early shows the system still self-corrects, for now. This ebb and flow highlights a key investor risk. Timing shortages is far harder than spotting them. Markets can stay functional longer than expected. Next, David Morgan talks about the deeper supply imbalance building beneath these temporary fixes.
So, not trying to be too long-winded, Elijah, the overall trend is very clear. We're using up more than we're mining. We're using up more than we can recycle. So somewhere down the road, that's going to occur to a point where it's going to be very tough to meet the demand without a big increase in price and someone willing to sell silver for fiat. And that's what we've already seen. We saw that in January. And I think that we're going to see it again. And I think the next time that we see it, we could, and not would, but could get in a situation where we get information, which you've already seen before out of the LBMA, that they're down to this much and they're going to hold deliveries off by 6 weeks because they can't meet the demand in that amount of time. So it's a very dynamic market. It does ebb and flow, but the dynamics, the trends are all in favor of silver investment.
Now, if we look at the day-to-day, week-to-week, month-to-month price action, a lot of people have been, confused over the last couple months as we've seen silver, for the most part, falling from, when we had you on, and silver was breaking above $100 now, so it went all the way to 120 intraday. Now it's around 70, 75 as we speak. And it seems like fundamentals have just gotten better for silver, right? You also have geopolitical risk out there, obviously, right now. So a lot of people are kind of confused. It seems very counterintuitive with everything that's happening in the world. You would think that metals would be racing higher. Why do you think they've been falling instead?
Yeah, I addressed this a while back, and it's counterintuitive, but you look at chart of silver's price and other war situations, you'll find actually the trend is counterintuitive.
Falling prices during tightening supply is where most investors misread the cycle. As David Morgan points out here, silver demand is outpacing mining and recycling. Yet prices dropped from $120 to around $70 to $75, creating a dangerous disconnect. This isn't weakness, it's often a liquidity-driven pullback, especially during geopolitical stress, when capital rotates into dollars instead of metals. The January spike followed by decline suggests positioning got ahead of fundamentals, not that fundamentals weakened. For investors, this is where patience separates winners from forced sellers. Next, David Morgan discusses why markets move opposite to logic during crisis periods.
If you get in the war cycle and you actually see the silver price go down for a while, and then you can see it bounce back. The reason is not an absolute, but the best determination I think is valid is the whole system still runs on interest rates. It runs on the treasury bond market of the United States. That's the primary source of what everyone trusts. I'm not just talking citizenry, I'm talking primarily the broker-dealer relationship in the central bank system relies on the US dollar. So when things get wacky in a war situation, rather than go to gold, which would be expected, they go back into the US dollar. And that's in the form of treasury bills, treasury bonds, treasury notes, dollar itself, currencies moving out of foreign currencies into the dollar, and that type of thing. And I'm pretty sure, in fact, the data shows that that is what has occurred.
War headlines suggest gold should surge, yet liquidity flows tell a very different story. As David Morgan points out here, during geopolitical stress, capital doesn't rush into metals first. It moves into US treasuries and the dollar, reinforcing the system investors claim to distrust. That creates a short-term suppression effect on silver, despite rising uncertainty, especially as bond yields and Fed expectations dominate pricing. For investors, this means macro positioning often overrides fundamentals in the near term. Next, David Morgan discusses how this liquidity shift distorts price signals even when demand remains strong.
And so that took gold down. Plus, honestly, to be objective as I can, gold, especially silver, got a little bit ahead of itself. I mean, look, in January of 2026, silver went up about 70% in a month. I mean, how many times have you and I done, interviews together and, silver moved, 10% for the year or 20% for the year. And now we're seeing 70%. So it was overdone for a while. It's recaptured its bullish trend. And I think we're going to go up again. But I also think we have consolidation to work off the large increase that we've seen. And I'm pretty convinced we're going to see a sideways action in a trading range for both gold and silver for probably 6 weeks or thereabouts. Could go longer than that.
Do you think we've found the lows? I mean, we had intraday, $61, $62 just a few weeks ago. Do you anticipate silver falling anywhere even close to that from here?
I do. I think that gold hit the 200-day moving average and bounced off it pretty strongly. And gold is still going to lead this market, although silver did catch up quite a bit last year where, gold was at the $3,500 level and silver hadn't done anything. And then after the summer, it started to really catch up to gold. We saw the gold-silver ratio go from, I forget the exact numbers, but from something like 100 down to 60. And we're in the mid-60s right now. I said weeks ago that I saw a trading range between 70 and 90, which is a big spread. It looks like it's going to be more like 70 to 80.
A 70% monthly surge isn't strength. It's a setup for exhaustion and reset. As David Morgan points out here, silver's January 2026 spike far exceeded its historical annual gains of 10 to 20%, signaling a market that ran ahead of itself. The pullback towards $60 to $70 levels reflects normalization, not failure, especially as gold holds its 200-day moving average, a key institutional signal. For investors, this phase is where weak conviction exits and disciplined capital waits. Sideways ranges often rebuild stronger trends. Next, David Morgan talks about how this consolidation phase reshapes positioning before the next move higher.
These are round numbers, but I also use OCO, on close only. I'm not trying to get too deep in the weeds here, but the way I've traded them, used to trade a lot more frequently than I do now. But at that time, I was taught the intraday moves are important, but it's on the close, OCO, on close only, that you really want the data. And I've integrated that. So if you go to OCO, you'll find that 70 number is pretty valid. You'll see those 60 prints during the day on the close. Most of them are above 70, not all of them. But when you're doing a channel formation, it's not a perfect up and down in a perfect range. It's, again, an art form more than a strict, principled math formula. But nonetheless, you get a pretty good feel for it. So I think we're doing exactly what I would expect at this time in the market. And unfortunately, in my opinion, the people that were late to the party or maybe bought it at 50 and watched it go to 100 and didn't get out, or people that are on leverage, or people that expect silver to, make up for all the mistakes they made in other investment arenas and what have you, are expecting too much. So the market going sideways will wear them out. And they'll say, you know what? I bought silver, cost me this much. The spread is this much. I'm kind of just breaking even. I held it for, 4 months. I'm tired of it. I don't like it. I'm going to get out. And those people, the weak hands, as we call them, leave the market. And once that happens, I shouldn't laugh, but I've been there, done that. We will see the market take off again.
The real battle isn't price. It's psychological exhaustion designed to push investors out. As David Morgan points out here, focusing on closing prices rather than intraday spikes reveals a consistent floor near $70, even when volatility suggests weakness. This sideways grind isn't accidental. It's where leverage players and late entrants get shaken out after chasing the $100 move. Markets often stall just long enough to transfer assets from weak hands to strong capital. For long-term investors, this phase is accumulation disguised as stagnation. Next, David Morgan unravels how this shakeout sets the stage for the next breakout.
Now, when you're talking the 70 to 80 range, you're talking about the gold-silver ratio here?
No, I'm talking about the silver price. As far as the gold-silver ratio, is a good question. Yeah, I think that might vary between like 60 and 70 I don't think it's going to get very extreme here. I think it's going to maintain its ability to do better than gold, from the top. In other words, when the gold-silver ratio is at an extreme and you could have, should have, might have traded your gold into silver and then maybe traded back at 50, which was the first alert that I gave to my members, my paid members. I said, look, if you want to swap into gold, don't swap it all at 50, but take a tranche, 20% thereabouts as a suggestion, and move in the 50 range into gold. And several did that.
Definitely. I think when it comes to these markets, it's hard sometimes to trade in and out. And fundamentally, often people are buying precious metals for the kind of long-term savings. But when you see those opportunities like 50 to 1 gold-silver ratio, it's hard not to, take advantage of those. Or, last year when we saw the gold-silver ratio 100 to 1, swapping the other direction. So I think even though kind of the mindset maybe should be kind of long-term holding, you can certainly play around with it this way, really to ultimately have greater gains down the road.
Yeah, thanks for backing me up on that.
Most investors ignore the ratio, yet it quietly dictates long-term wealth gains. As David Morgan points out here, the gold-silver ratio, moving from 100 to 50, effectively doubles gold exposure for those who time the swap, even after fees. That's not speculation, that's strategic rebalancing based on relative value, something institutions monitor closely. While retail focuses on price direction, smart capital tracks these spreads to optimize positioning. For portfolios, this is about efficiency, not just growth. Next, David Morgan discusses how disciplined ratio trades can outperform simple buy and hold strategies over full cycles.
I mean, it's not something you can do all the time, but when the advantage is there, it's 100 to 1. And just think about the people who did that were maybe all silver or too much silver, however you want to frame it. And it went from 100 to 1 to 50 to 1. All of a sudden, they doubled their gold position. Of course, there's, fees and all that. So it's not exactly double, but in theory, it's double. And, gold's a lot easier to, stack, and, it's a lot smaller volume. And I always have taught that you should have both. They really serve different purposes. And silver, as we all know, is just much more volatile. But to make that trade when, you're kind of tempted to buy gold and it's getting all the news headlines and the institutions are buying gold and central banks are buying gold and gold. But you look at that ratio, man, I'm going to buy silver because I want cheap gold. And you buy it 100 to 1, then it gets to 50 pretty quickly when it moved. And you swap that, you feel pretty happy. You bought gold basically at half price.
The biggest gains often come from decisions that feel uncomfortable in the moment. As David Morgan points out here, buying silver when gold dominates headlines, especially at a 100 to 1 ratio, requires going against institutional momentum and media narratives. Yet that contrarian move can effectively halve your gold acquisition cost when the ratio normalizes to 50. This isn't frequent, but when it appears, it's a high-impact opportunity for disciplined investors. Balancing gold's stability with silver's volatility creates resilience.